Are you looking for smart and hassle-free way to grow your wealth, and are you able to invest regularly without worrying about the market timings? Here we go. In today's video, we are diving into the world of SIPs. Whether you are a seasonal investor or just starting out, SIPs offer simple and effective way to build your investment portfolio. So what is SIPs? SIP is Systematic Investment Plan. It is a method of investing in mutual fund where investors contribute fixed amount of money at regular intervals, typically monthly or quarterly. And it is designed to help the investors build their wealth through consistent investing. There are certain benefits of SIP. Some of them are discipline and regularity in investing. It is affordable to all the investors. It is convenient and it is flexible. It reduces the emotional investing, rupee cost averaging and compounding effect. What is this rupee cost averaging and compounding effect? How these benefit the SIPs? Rupee cost averaging is an investment strategy where investors regularly invest a fixed amount of money in a particular investment such as mutual funds. It reduces the impact of volatility on the overall purchase, and it results in buying higher units when the price is low and fewer units when the price are high. This average effect helps the investor to reduce or lower the average cost per unit over time. Now let's see how this rupee cost averaging works with an example for short-term period and long-term period. If you are monthly investing an amount of rupees 10,000 for the investment period of 6 months, then mutual funds net asset value is as follows. Here we have taken January to June as the investment period. The net asset value for the month of January is rupees 50. The investment is 10,000 and the unit purchased is 200. In February, the net asset value is rupees 40 and the investment is same as January, it is 10,000 and the unit purchased is 250. And in March, the net asset value is 60 and the unit purchased is 166.67. In April, the net asset value is 55 and the unit purchased is 181.82. In May, the net asset value is rupees 45 whereas the unit purchased is 222.22. And in June, the net asset value is rupees 50 and the unit purchased is 200. The total NAV for the 6 months is rupees 49.13 whereas the investment is rupees 60,000. The total number of units purchased for 6 months is 1220.71 units. Despite the fluctuations in NAV, the average cost per unit comes out to rupees 49.13, which is lower than some of the higher NAVs during the period. And here comes the example for long-term investment period. If you are investing monthly an amount of rupees 5,000 and the investment period is of 12 months, the NAV is as follows. For January, the NAV is 30 and the unit purchased is 166.67. For February, the NAV is 28 and the unit purchased is 178.57. For March, the NAV is 32 and number of units purchased is 156.25. April, the NAV is 31 and unit purchased is 161.29. For May, NAV is 29 and the unit purchased is 172.41. For June, NAV is 33 and unit purchased is 151.52. For July, NAV is 34 rupees and the number of units purchased for July is 147.06. For August, the NAV is 30 rupees and the units purchased is 166.67. In September, the NAV is 27 and the number of units purchased is 185.19. October, the NAV is 35 and the units purchased is 142.86. For November, the NAV is 32 and unit purchased is 156.25. For December, the NAV is 29 and the unit purchased for the month of December is 172.41. Hence, the total NAV for 1 year is rupees 30.68 and the investment is 60,000. The total number of units for an year is 1956.15 units. In this long example, despite the NAV fluctuating between 27 and 35 rupees, the average cost per unit is rupees 30.68, demonstrating the smoothing effect of rupee cost averaging. Now let's see few examples with different scenarios and the suitable fund type for the better understanding of SIPs. Scenario 1, long-term wealth creation. Then you can opt equity fund type with a monthly SIP of rupees 5,000 and the investment horizon is 15 years. The expected annual return is 12%. The total amount invested in this fund is rupees 9 lakh. The returns which the investor gets is rupees 16 lakhs 22,880. The overall earnings on the fund type of equity is rupees 25 lakhs 22,880. The second scenario is children's education. You can opt the fund type balanced fund with a monthly SIP of rupees 10,000. The investment horizon is 10 years. The expected annual return is 10%. The total amount that you are investing in this fund type is rupees 12 lakhs. The returns which we get is rupees 8,65,520. The overall earnings is rupees 20,65,520. The third scenario is retirement planning, and the fund type is equity linked savings scheme with a monthly SIP of rupees 15,000. Investment horizon is 20 years. The expected annual return is 12%. The total amount invested in this fund is rupees 36 lakhs. The returns is 1 crore 13 lakhs 87,219, and the overall earnings is 1 crore 49 lakhs 87,219. And fourth scenario is short-term goals, and the fund type is debt fund with a monthly SIP of rupees 5,000. The investment horizon is 3 years. The expected annual return is 7%. The total amount invested in this fund is 1,80,000, and the returns is 20,815, and the overall earnings in this fund is 2,815. The fifth scenario is buying a house, and the fund type is multi-cap fund. For that you have to invest in SIP monthly rupees 20,000, and the investment horizon is 10 years. The expected annual return is 11%, and the total amount invested in this fund is 24 lakhs. The returns is 19,79,746. The overall earnings on this fund is 43,79,746. And the next scenario is emergency fund. For this, the fund type is liquid fund with an SIP of monthly 3,000. Investment horizon is 2 years. The expected annual return is 6%. The total amount invested in this fund is 3,60,000, and the returns is 1,34,096. Overall earnings is 4,94,096. Next scenario is travel goals, and the fund type is hybrid fund with a monthly SIP of rupees 5,000. Investment horizon is 5 years. The expected annual return is 9%. The total amount invested in this fund is rupees 3 lakhs. The returns on this fund is 79,949. The overall earnings on this fund is 3,79,949. The next scenario is daughter's marriage, and the fund type is small cap fund with a monthly SIP of rupees 10,000. The investment horizon is 15 years, and the expected annual return is 14%. The total amount invested in this fund is 18 lakhs. The returns which we get on this fund is 43,28,538. The overall earnings on this fund is 61,28,538. And the last scenario is health expenses, and the fund type is conservative hybrid fund, and the monthly SIP is rupees 8,000. The investment horizon is 7 years, and the expected annual return is 8%. The total amount invested in this fund is 6,72,000, and the returns is 2,30,886. The overall earnings on this fund is 9,02,886. And the next is power of compounding interest. Compounding interest means the interest you earned on your savings is added back to the principal amount, and then you earn the interest on the new large principal amount. For example, to know the power of compounding, let's assume the principal amount is 2 lakhs and the annual rate of return is 10%, and the investment period is 5 years. At the beginning of the first year, your principal amount will be 2 lakhs and the annual returns will be 20,000. And at the end of the first year, your new principal amount will be 2,20,000. At the beginning of the second year, your principal amount is 2,20,000 and the annual return is 22,000. Your new principal amount at the end of the second year is 2,42,000. And at the beginning of the third year, the principal amount is 2,42,000 and the annual returns is 24,200. Your new principal amount at the end of the third year is 2,66,200. At the beginning of the fourth year, the principal amount is 2,66,200 and the annual return is 26,620. The new principal amount at the end of the fourth year is 2,92,820. At the beginning of the fifth year, the principal amount is 2,92,820 and the annual return for the fifth year is 29,282. The new principal amount at the end of the fifth year is 3,22,102. After 5 years, your investment grows to approximately rupees 3,22,102 and you have earned an interest of rupees 1,22,102. This is the power of compounding. So start early to get more corpus. Here is some small example for late investing and early investing. Here I have taken two investors with the same investment amount of rupees 8,40,000. Their expected return is 10%. The first investor X, he is investing at the age of 25 with a monthly SIP of 2,000 and his investment period is 35 years. And the second investor Y, he is investing a monthly SIP of rupees 2,800 from his age of 35 with an investment period of 25 years. From this we can know that investor Y has to pay more amount in a short term period to get the total investment of 8,40,000. And this is the best example for starting early with a smaller amount can result in a large corpus due to the power of compounding. There are three common myths about SIP. First one is SIP works only on the bull markets. It is absolutely wrong. SIPs works on the falling and rising markets due to rupee cost averaging. And next one is SIP guaranteed returns. SIP do not provide guaranteed profits. Instead, the profit is dependent upon the underlying mutual funds performance. Third one is it requires large amount to start, but SIPs requires the small amount as low as rupees 10 per month to start. There are certain factors that are needed to be considered while choosing an SIP. First one is fund performance. To know about the fund performance, you have to look into the historical data and returns on various periods. Second one is expense ratio. The expense ratio should be lesser. Third one is fund manager's track record. You have to know about the fund manager's experience and the records of the fund manager. Fourth one is risk profile. Ensure mutual funds risk profile aligns with your risk tolerance. Equity funds are riskier but have higher potential returns, whereas debt funds are safe with moderate returns. Fifth one is fund objectives. Choose the fund that matches with your investment objectives such as growth or tax savings or income. We hope now you understand what SIPs are and how they work and why they might be the perfect investment strategy for you. For further queries, please visit our official website choiceindia.com. This is MM signing off. Thank you.